Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have David Nage, portfolio manager at Arca, an asset manager in the digital asset space. David's responsible for sourcing, due diligence, and supervision of new allocations for the Arca Endeavor Fund. He joins me to discuss what the crypto space can potentially learn from FTX to make a better future for the industry. David, it's great to have you with us. Welcome to Trade Talks.
Great to be with you, Jill. Looking forward to the chat.
Yeah, me too. And David, you typically focus on early stage private market investments, but I want to get your take on the latest happening in the crypto space. Explain what happened with FTX and why the crypto market went into free fall.
Now, again, I want to be clear here. Obviously, we have no direct exposure or we have no direct knowledge of the issues that happened at FTX. We are not investors in FTX. And so all of this is being obviously documented and read, very similar to everything that's happening with everyone else out there. What we know from reading what we've been able to read and ascertain is that FTX, effectively a very large centralized exchange, which had, as of most recently, had raised at a valuation at $32 billion a few months ago, was experiencing some issues, that for those in traditional finance are familiar with. Back, about a decade ago, there was a separation of church and state called the Wackler rule, where you had to separate assets. And it seems that a relationship between entities there were not necessarily to the point of where the Wackler rule was obviously stating for traditional finance. That has caused some issues with liquidity over at FTX. And over the last few days, FTX has been reaching out to counterparties to see if they can raise funds to potentially mitigate that gap. That's what we know. That's what we can see from the reporting out there, from the different journalists and different segments out there. But that's what we know today. So as of right now, FTX is still trying to source funding to potentially mitigate that gap. According to their founder, they've been reaching out to various parties, including other exchanges. And we are all waiting to see the results of that. The outcome of that has been more uncertainty within the market. There are those that have had funds that have been tied up within FTX. They have not been able to withdraw it. There is some reporting over the last hour that some of those withdrawals are actually happening now. We don't know exactly to the extent of that. But as of right now, that has been a major problem with the market, is that a very large exchange where many investors, other projects in the space have been depositing their funds, have not been able to access to it. And so when you have that problem of frozen funds at an exchange, that obviously can cause cascading fear in the market.
Yeah. So David, what does this mean for the crypto space overall? Is this systemic or specific to over-leveraging and lack of risk control? Your CIO, Jeff Dorman, he told CoinDesk that regardless of how it ends, it's another blow against the industry and financial institutions in general, is simply for a lack of voluntary transparency, but it's another giant checkmark for the transparency of blockchain data and the skilled researchers trained to uncover, read, and interpret this data. So it sounds like the underlying technology is going in the right direction, but we've got to figure this out when it comes to leveraging risk control and getting some sort of regulatory framework around this.
I absolutely agree. As a firm, we have been advocating for a sensible regulation here, a sensible regulation that also adheres to the innovation that is within the digital asset confines itself. Very similar to what we saw in the late 90s with sensible regulation that allowed the internet to flourish. We believe that that's a regulation is necessary here as well, too. But my colleague and my partner, Jeff, has a very good point about DeFi. If we talk about that as a sense, DeFi is really where you have the ability to have immutability and transparency in transactions. This is why many people in TradeFi have actually crossed over to the chasm of digital assets over the last 5 years, because of that promise, the ability where you can actually see when transactions are happening, see if there is leverage, see what type of activity are happening on wallets in real time. And Jeff is absolutely correct, and I completely adhere to this as well, too. The forensics that we have today is better than we have ever had before in this industry. And be able to have those analysts be able to provide that analysis in real time on Twitter and other social media platforms and to the press is really fantastic, and is actually a feature, not a bug, to what this industry can do.
And specifically for your focus on early stage and private market investments, what do you think happens next there? What does a valuation environment look like now?
We already saw a re-rating of the valuation market back when Luna and BlockFi and Celsius happened a few months ago. We saw that, especially for seed stage, where we spent a preponderance of our time, had a re-rating. Where this time last year, seed rounds were typically topping off around 30 to 35 to 40 million post-money valuations. That was cut in by about half, where we started to see seed rounds posting around 20 million post. I think we believe over the course of the next few weeks, and again, it's very early because these things are fluid. We do believe that there will be a re-rating in the market again. We don't know to the severity and the type of extent that will be, but what we do know is that what we've seen over the last few months, founders are building. They're building sensible, real businesses. They are also now really working with Web 2 companies, Nike, working with Artifact, Starbucks releasing Odyssey in the next few weeks. Real companies with balance sheets that are in the billions, that are multi-conglomerates out there, that are multinational. They're working within the Web 2 to Web 3 confines. And so we see founders building within that, and we see a lot of innovation happening there. But yes, there will probably be a re-rating in the market. We just don't know to what extent.
Right. And David, I've been asking traditional asset class managers this as well when it comes to the private and public markets. This valuation reset almost needed to happen, right? So that you can kind of shake these outliers out, make it a fair marketplace for investors. And do you think in the digital asset space that this valuation reset almost needed to happen as well?
I think it's a normalization. I think yes, I think that is actually a fairly good thing. I think what happened is, there was a lot of innovation that happened over the last few years. There's a lot of infrastructure that's been built. There have been a lot of institutions that have come into the space. And so you've had a lot of capital out there on the sidelines that over the last 2 years really started to see a reason to come in. And so with a lot of dry powder out there, you saw a lot of valuation starting to creep up. And so I think what we're seeing, we saw in Q3 some reporting out there that around $5 billion was poured into markets in the private side. That was down from the previous quarter. I think right now where we stand is that $32 billion has been allocated to private markets and to venture in this up until this point in November. I think that will probably continue to slow down. And when you see that, we're also starting to see not only the valuations continue to normalize and come down, but the duration of deals is also starting to normalize. Whereas the market was running incredibly hot a few years ago, deals were running every 2 weeks to 3 weeks. Now we're seeing 4 to 6 week durational periods, if not longer. This is also a good thing. There's been a lot of conjecture out there that the amount of diligence was not necessarily done to the types that you would typically look for things like FTX and other positions out there. With the kind of durational period extending, it's my hope that our peers out there will continue to do the types of diligence that they're capable of, and they'll be able to continue to fund really good founders that are building great projects.
All right, David, appreciate the insight and all the great work that's being done over at Arca. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.